part 2 of our discussion of the revocation of licenses of fund managers by the SEC. And in this segment or this part, we are talking about the workings of a fund manager. Now, their licenses have been revoked, and so some of them are not existing anymore. But those that are existing, we want to understand how they work and what to expect from them. With me today, we have Koduah-Sarpong of Sarpong Capital to discuss the workings of the fund management companies. Welcome once again.
Thank you.
Part 1 was very interesting, and I had to come back for part 2.
Yeah.
Or actually, we were sitting here for part 2. All right. So in this segment, we want to discuss fund management companies. Now, some licenses have been revoked,
right,
but the business will continue.
Of course.
And so understanding the business is important.
Yeah.
Right? So we want to, first, an investment firm is very different from a bank in that the first thing is that investment firms will not take your deposits.
Yes.
They would hold your deposit in trust for you with a third entity. Okay. So the first step is to ensure that your funds don't sit with the investment firm, but they lodge it somewhere else. Is that right?
Yeah. Yes. To a large extent, you're right. In respect of investment firms, and I like the fact that you call them investment firms because we're now going to separate them into two. They're what we call the investment advisors, and then we have the investment managers or the fund managers themselves. Two separate classes of the same license. Now, when you're an investment advisor and you're licensed as an investment advisor, all you can do is provide advice around investments. So, which stocks to buy, which mutual funds to put your money into, which bonds to buy, right? Or the investment advisor mostly can also provide portfolio structuring advice. Structure your portfolio this way or that way based on these criteria, but they never ever take the funds in to manage.
That's advisory.
That's investment advisory. Investment advisory. So in that respect, the fees that they charge are only investment advisory fees.
Okay.
Right.
Wait, but how is that structured? Because the advice must be good advice before I want to pay for it. So how is that structured? Does the advice need to be good before, or just because I walked in I need to pay?
So that's the thing about investment advisors. So you would provide research. Investment advisors would provide research to support any advice that they give. So if an investment advisory firm is providing you advice on, say, fixed income, consider putting your buying maybe what's called GOG 24s or 27s or whatever it is, then they'll be supporting that with research. And they provide that research, and then they provide you with a recommendation as to how to go about it. Then you can take that information to your fund manager if you have one, and then they will do the management for you. Right? Now, in that case, in that particular relationship, there is no fiduciary relationship with respect to the monies that have come or are available for investing. So now when we come to fund managers or investment managers, that's where the ball game changes, because now you have an investment advisor who now has the ability to take your funds and hold and then do the investments on your behalf when the decision or the timing is appropriate, and then they move money to go into the various investment areas. So now in those kind of relationships, you have a number of options, and those options start from the investment policy statement. So
no, but well, I think we're getting ahead. How does a fund management company onboard a client?
Okay. Let's start from, so we're starting from the onboarding.
Yeah,
right.
onboard.
So to onboard, let's just say I've met you or wherever, and I've done all the pitching I need to pitch, and you're now excited about working with my small investment advisory firm, Koduah-Sarpong firm. And I start the onboarding process by capturing some data from you. So your name, your age, all those demographic stuff, source of funds. Then do a risk tolerance analysis to establish what kind of risk, from a risk perspective, what kind of risk profile you have, because that invariably feeds into the investment policy statement or the types of investments that we can do on your behalf. So to onboard you, we do all of that work. So it's no different from opening an account at a bank.
Okay, so KYC,
AML, CFD, CFT, everything is done at an investment management firm.
Okay.
And sometimes it can even get more pedantic than at a bank.
Okay.
Because the thing is that because investment firms are, in our side of the world anyway, they are largely smaller than banks. You have a lot of illicit flows flowing into that side and all of those things. So the level of due diligence that needs to be done on the source of funds is more pedantic. Should be pedantic at that level than if you were.
Well, it should be equal.
Well, it should be equal, but because they are small and many of them are under the certain regulatory radar, so yes, you do have the SEC as your broad regulator, but beyond the SEC, nobody else is looking at anything you're doing.
Okay.
So it's very, very important that the KYC and the AML work that's being done at that level is of a very high quality.
Okay. So all that has been done. The client is ready to engage you as investment advisory and manager.
Yes.
What happens? What information does the customer walk away with, or your client walk away with? What are they walking away with after giving you all that information and then assigning their funds to you? Now, how does that happen? Do they write a check directly to you, or how does the money change hands?
So, in many instances, there are various channels through which funds can flow between clients and the investment firms or the custodian accounts that they have. I know some firms take checks, some firms take cash, and some sophisticated firms actually use debit cards in ours. And I believe I've seen one that uses Zenith Bank, so as a collection point. Increasingly, many of the fund managers are making it easier for their clients to move money from their checking account into the investment account at the custodian.
But I see a problem here. If the investment firm is not supposed to take the funds, shouldn't it give instruction that it should be paid to the custodian bank directly, so that the focus is how to get the money out of the investment firm?
Okay.
So that a client like me would have assurance that I didn't give the money to the firm. I paid the money directly into an account that I knew we had signed an agreement for. Okay,
because I think you have something against these custodians. You want to really get them there, but they really have done nothing wrong, and the relationship is between the investment firm and the custody bank. So when a client is bringing funds for you to manage on their behalf, you're not taking it as a deposit, and that's the key difference. It's not a deposit, because deposit connotes that they can come and pick it up at any point in time. Because it's not sitting there in a checking account or something of the sort. But it's not a deposit, it's an investment. So when they're taking funds to manage on your behalf in investments that together you agree on, or if they have the discretion to invest on your behalf, where they place it, you can't really...
You can't remove the fund manager. He has to collect it.
Yes, he
trust him to...
Yes, and he must move it into his, for the lack of a better word, custody account that he holds on your behalf. It doesn't go into his own account. So many investment firms you find will have their operating account. Let's say they hold a bank at Zenith Bank. You have the operating account, and then they would have what we call either a trust account or a custody account with Zenith Bank as well. And then client money is going to those accounts, right? So once that happens, when the firm is going down, nothing happens. If the money is still sitting in the custody account, there should be no problem.
Or even if it's being invested, it's still there.
It's invested, there's a track record or records of where the funds have been placed or in which instruments. If it's gone into the stock exchange, you've got the equity certificates and whatnot. And come on, right now, even most securities are demutualized right now, meaning they're in electronic form, so they sit in CSD.
Yeah.
So on top of having the investment firm having a custody account with Zenith, you, the investor, also has a CSD account for instruments that are bought on the stock exchange or the alternative exchange or the bond market. So the securities are sitting electronically in places where it's not getting lost.
So I think this is building some confidence. Now, I started this discussion thinking that the investment firm had unfettered access to the funds. But in actual fact, the funds are sitting with the custodian, number one.
Yes.
When an equity or a bond or some investment is made, it also has where it's sitting.
Of course.
And so I think there's some confidence coming with this discussion.
Now, if you give it as a fixed deposit, it doesn't go into the custody account.
Yeah.
It goes into the firm's coffers.
Yeah.
And that's where the problem is.
Okay. So, and that was in part one when we discussed that. So now we are looking at the real business.
Yes, the real
where the money went into a custodian. Now, let's look at the investment policy statement.
Right.
All right. That statement is guiding what the fund manager should do according to the risk of the client. Exactly. Is that correct? Okay. So that statement, most people, how do you explain it? Can you break it down into segments or types of statements so that if there's a risky one, a less risky, the middle ground, so that people can know what spectrum they are looking at? So in broad areas, can you chunk it up?
Okay. I think I'll do you one better. I'll simplify the whole conversation, and then we don't have to break it up too much. When you take the investment policy statement, based on the level of onboarding that was done, if I did my onboarding properly, I've collected so much information about you, I did a risk tolerance assessment, I know what your risk tolerance is, and therefore I know the type of portfolio that I need to construct to match that risk profile that I constructed at the onboarding stage. So if I've done that work well, my work at the allocation side is relatively easy. Let's say you're 35 right now, and you're thinking about retirement probably in 25 years from now. And in 25 years, what can be invested for you? That's a long-term horizon to look at. So naturally, the risk tolerance, but we don't have too much information, but if I assume that the risk tolerance was moderate to high risk, then we would be constructing a more aggressive portfolio for you, one that can stand the test of time. So it can take the peaks and the troughs of the equity market or whichever other market that we decide to put your money into. And therefore, we would allocate the funds in a way that reflects your risk profile. So you see more of the money. Kojo gave us 100,000 CDs. So more of that 100,000 more of that 100,000 CDs will be going into equities, right? And then that would be the construction of your portfolio. And then a few other places, fixed income, we'll hold some cash, maybe some 5% in cash, and then a bit of it in some extremely high risk assets like private equity or maybe if there are hedge funds in town, or maybe currency. And then we look at that as a portfolio. So your returns are not going to be on an individual basis, but we look at them relative together. So we add your returns up across the asset classes to arrive at a return for you. And that return is benchmarked against some index. It could be,
are there a lot of indexes? Because now...
Yes, we have a number of indexes or indices. We've got the Ghana Stock Exchange Composite Index, and then we've got the Financials Composite Index of the sub-index, and then there's the Data Bank Index as well. NDK has a bond index. I do remember, I think Gold Coast also had an index, a currency index, a CD index of some sort. So yes, there are indexes or indices that are
okay.
available.
So these indices, usually to have index, you need to publish what's in that, what's forming that.
Yes.
But is there visibility on, because if you're a fund manager and wanted to mirror a certain index by the risk profile, you should have that. Are these indices that sophisticated enough? Can you see the proportions of what asset class is in there? Because it's just a number, but if you wanted to mirror it, is it possible to do that?
I cannot speak for the firms that have published their own indexes, but I can speak for the Ghana Stock Exchange one. It is it's an open index. You know the constituents that make up the index, and therefore you can replicate the portfolio in your portfolio in that particular. If you wanted the exact similar performance of the stock exchange, then you could replicate the equity side of your portfolio to match that, and therefore we would benchmark the performance of that asset class against that particular index. Or, if it was in a mutual fund, if we put the money, your funds into a mutual fund, or we created an asset allocation, and within the asset allocation table.
Mutual fund assets.
Sorry?
Is it that you mirror a mutual fund that's existing?
So what I'm saying is that in your asset allocation, there's an allocation that goes to collective investment schemes. And that allocation is more of, you are putting money into a fund that also has a policy that invests in different things. So you are relying on the knowledge of your current fund manager to invest your money for you, and invariably he also relies on some fund manager who is managing the mutual funds, picking strategies to stock picking strategies or bond picking strategies to create returns in that particular fund. So if we had an allocation for you that goes into the mutual funds, then what would happen would be the money goes there.
Straight into that.
So we buy into that one, and then the performance of that particular asset class within your portfolio is now benchmarked against the performance of the mutual fund.
Okay, so
and the mutual fund is, if it's an equities mutual fund, they are trying to beat the GSE, or if it's the data bank index that they are trying to beat. So you can benchmark that mutual fund's performance against those particular indices, and then see how it's performing as well. So now always you want your investment portfolio to be benchmarked against some index of some sort. So it could be if you're looking at it against treasury bills, that's a very it's a low risk index if you had to do that, and I think that it's a very lazy way of benchmarking.
It's very safe. Can you look at it from a safe point of view rather than lazy?
Well, if your portfolio is an aggressive one, why would I be benchmarking against the treasury bills? It has to go against so match apples and apples and apples, and not apples and oranges. So that's the philosophy. Benchmark it against something of a similar construction.
Okay, so now the investment horizon is over, so there's a maturity date approaching. How does the client get their money out?
Okay.
Is it to you? So there's a maturity of the maybe after 5 years. Every year there was a benchmark, and
the returns will be effectively.
So now it's 5 years. He needs the money to invest. How does he
invest? He's already invested.
Yeah, to buy, not to spend. There's this investment, and when it matures, they want to buy a house.
Okay. All right. So moving into the real sector.
Yeah, moving into the real sector. Okay. Invest in the real sector. How does clients do that?
All right. If I've done my onboarding well, and I think all of this goes back to the onboarding. Many problems that happen with many investments starts from the onboarding. If you get the onboarding wrong, then you have problems throughout. If I've done my onboarding right, I've collected your settlement instructions. So the same way in Treasury, we've got SSIs for the same thing. We have SSIs for that. And a properly constructed onboarding pack would have sections for SSIs, where you give
standard settlement instruction.
right, where you give the firm information about where your account details, where you want the money to go at the end of any investment, or if there are any dividends or there's any interest payments that need to be made to you after what we call corporate actions, then we send it there. So when the onboarding is done right, we got all your details. If you change the details, you let us know. If you
update.
Yes, let's say you had what's it called? You had a bank that's no longer in existence. You now moved to Zenith Bank. Inform us that you've opened an account at Zenith Bank. Please change our details, and then we'll validate it and make sure that it's coming from an authorized person. Because it's very important that those instructions to change the details are coming from an authorized signatory to the account. So once we have your SSIs, corporate action happens, dividends come to you, interest income comes to you, and then you're happy. At the end, principal moves back into the account.
Okay. All right. So now we're done with the clients.
Yes.
Now let's look at an investment firm that has its own capital that needs to also generate some money. I mean, you can't just be making money for your clients. You need to also, apart from taking charges and all that from the clients, you also have to do some prop trading, some proprietary trading on your desk. Does that happen?
Look, as an investment manager, right, you're about 90% of your revenue is generated from the fee you charge on the assets that you're managing. So to move out of that into prop trading for investment managers, not quite so. Yeah, they may have some strategies that they want to test, and they use their own capital first to test those ones. But there are capital requirements. So if you test it and it goes bad, you fall below your minimum capital requirements or minimum liquidity requirements, and you get a regulatory sanction. So for investment management, it is a very safe business. It's assumed to be a safe business from a firm point of view or shareholders' point of view. You should not be losing any money as an investment manager. You losing money means you are not collecting assets to invest on behalf of clients. So when your operating overhead exceeds the assets under management you have, the revenue generated from those ones, then you have a problem. So let's say on average, you can expect to generate between 0.15% to the very sophisticated asset managers charge up to 2%.
Really?
Yes, on assets under management.
On the assets under management?
Yes.
Do they charge a percentage on the income?
On that one, you move into the hedge fund territory, because they have the 2 and 20 approach where they charge 2% management fee and a 20% performance or incentive fee for any returns generated above a particular watermark or threshold. Then they get to participate 20% in there.
But
that would for I mean, many firms in Ghana don't do that, because many of the fund managers in Ghana are more retail than retail and actually mass affluent than high net worth to be able to do those ones. Yeah, so you don't really see the 2% here. You see it on the lower side. So you end up having to collect a lot of assets to manage in order to sometimes break even. And there's a lot of technology that you have to put in place. I mean, you're doing retail asset management. Touch. You have so you need to try and automate it. Those are some of the things that you use to differentiate yourself. So a lot of firms spend money on technology. Those that don't, you find out that they lag behind the curve.
All right. So I think it's a problem that fund managers or investment firms are not investing their own capital. All right. That they are not testing themselves with their own money, but with clients' money. Okay, so if you wanted to choose a firm, you want to understand how well the firm is performing with clients' money, that's good. But on your side, on your money itself, how well are you managing that? And isn't that supposed to be a track record?
That's a very interesting one. I haven't come across a question like that before. It's very interesting. Look, the investment managers whom I know do that are hedge fund managers. They invest their own money as well as clients' money as well as private equity fund managers as well. But when it comes to retail, the reason they come to you is because they need the professional advice.
Okay.
So we expect, and it's also part of the compliance manual, that you have professionals.
Okay.
And in many, ordinarily in many firms, the portfolio constructors or the portfolio strategists would be like CFA charter holders or stuff like that, or proper investment professionals who understand the business of investment management and how to manage risk, and also the attainment reward attached to it. So for me, I think that once we have firms that have qualified people from a professional point of view, and also they have strategies in the form of various collective investments, because you see, what you have is, if you have a mutual fund, right, the mutual fund has its objective. And if you've picked the Data Bank ARC fund or Data Bank B fund or M fund, the prospectus, it's got the investment objective there, how they plan on using the money. So that's where the pitching is. Pitching it to investors to subscribe lies in that particular document. So it will surprise me that any fund manager will recommend either Data Bank or IC Securities or EcoBank, a fund from one of those firms, and they wouldn't be pitching on the basis of the objectives in the prospectus. So if you look at the objectives and then you compute how they plan on operating, you can backtest it against historical data. And I expect that the mutual fund or the mutual fund managers themselves would show the backtesting results. So that's an easy way of doing it, so you don't have to put your own money in.
Okay.
Test the strategy, backtest it against historical data, and see what the returns are going to look like. And many of them do the backtesting. So when you've done the backtesting, that's when you can say that we're targeting a 25% return for this fund. If it doesn't pan out, then you find that your investors are going to leave and go to the next best thing.
Okay. We're here at Treasury 360 with Sarpong Capital, the founder and the chairman, Mr. Kofi-Sarpong, discussing the fund management space. And the part one of this discussion dealt with the revocation of licenses, and part two is sort of like the way forward. All right. So we're trying to understand how the workings of the fund management companies go, and what safeguards are there for investors that want to invest with these fund management companies. In conclusion, we want to discuss the risky part of fund management. All right, which means the investments that are risky and what sort of liability you carry if you sign on to a certain investment policy plan that does that. Right. So, which part of this investment policy agreement that says you can lose all your money?
Okay. So, I think first and foremost, before I come to the investment policy, I want to mention that when you are managing client money in a fund, whether it's a private fund or it's in a mutual fund, you still have to follow risk management rules. And we'd expect that you have a middle office and a risk management team that looks at portfolio risk on a portfolio, the risk on a portfolio basis. So when the portfolio is not performing as it's supposed to perform based on the risk profile, be able to spot it.
Okay.
So if a fund management firm doesn't have a risk management team in-house, first flag, you don't have how are they going to track portfolio risk?
Okay.
You can't.
Yeah,
so you see, investment
is this a
management
duty for SEC, auditors, or the client?
First and foremost, it's a duty for the investment management firm.
Okay.
It starts from there, because you are managing people's money. So you have to, you've got to put risk management framework in place to manage portfolio risk. But I mean, in an earlier conversation, I did mention that in Ghana, investment management is vanilla, very vanilla. Okay. So most of what happens is, okay, I've taken Kojo's money, I bought treasury bills, that's it. I've taken Koduah's money, I bought equities, and that's it. But where is the portfolio risk?
Okay. So the risk is inherent in the equities that you bought?
It's inherent, but as a portfolio, you need to be able to know that, okay, this is my targeted standard deviation or the risk metric that I'm using. This is a target that I have. Is it currently outside or within that range? If it is, then if it's outside of the range, what corrective action must I take? Must I rebalance the portfolio?
So active portfolio management.
Thank you very much.
Okay, so active portfolio management will now lead to the question, are the portfolios being marked to market, for example, or what kind of risk measures are being taken? So are they cross-checking on the market?
In terms of marking to market, these are conversations that are currently ongoing in the industry, and I wouldn't want to front run any decision being taken by the SEC, but I can say that mark to market is a conversation that's being had across the industry for actively traded portfolios like mutual funds, because if a mutual fund has treasury bill holdings and is actually trading it in the market, then you expect mark to market to take place. Where it's a closed-end fund where you're not inviting new subscribers and you bought it and you're not actively trading, then the key question becomes, should it be mark to market, or it's to be treated like as a held to maturity portfolio, and therefore it can avoid the mark to market treatment. These are questions that are being had in the industry as it stands. I know it got raised up at the pension level for the pension funds, and it's now trickling down into the retail side of the market.
So was it raised or has it been enforced?
It's a conversation. I cannot speak for the regulator at the moment, but it is a conversation that I know has gone on.
Okay. Well, in the markets, it's very interesting that this conversation is being had. It means that if fund managers are made to market, it means when a portfolio, the value of some instruments that they are holding is falling, they would now be obligated to sell it and create more activity on the market and get more active management of a portfolio rather than held.
Market to market is great because if you're a proponent of a secondary market, then market to market allows you to get the trading going on. But you can also understand some investors, their wariness to actually mark to market, because if you ask to mark to market and then take a whopping loss today against his portfolio, he's not going to be too happy about that. So that's why I said it's a conversation that is ongoing, but one that I believe the regulator must at some point in time decide on where the market needs to go on that.
Wow, so it's been a good discussion, and perhaps based on the comments that we get, we might decide to expand the conversation some more on the workings of a fund management firm. All right, you've been watching Treasury 360 with me, Koduah-Sarpong, and Koduah-Sarpong. Thank you for watching.